Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from what I can only call a beautiful and pretty much fall day here in Denver, Colorado. I was reminded that we don't get rain and chilliness for too long here in Denver. Yesterday we moved back into the sun and it was absolutely fantastic. Always nice to get a little bit of warmth back when we do get hit with a little bit of rain. So I am pleased to be here with all of you. I hope you all are excited as well. We're going to get down to looking at a number of charts today. We've got some stocks in the news, as we always do, but we're going to work our way through the major indices, some sectors on the move, and hit a bunch of charts for you today. We also, because it is a solo Thursday for me, we will also be looking at our existing example trade from the Trader Talk session, which we put on a few months ago, and take a look at how it's treating us, maybe raise an exit strategy on that as well, and might even start a brand new trade this morning to see if we can give ourselves something else to track as we go forward here. So take a minute and say hi to Connie Hill in the chat. She, of course, is a colleague, a friend, an excellent coach. You will note that she'll be answering questions that I'm unable to get to, of course. I'm going to try and keep an eye on things for you there, though, so please feel free posting in there for the entirety of the show. If you're not already doing so, don't forget to be subscribed to the Schwab YouTube coaching channel. We call it Trader Talks. Good way to make sure that you're getting all that we offer here on the channel, of course. And remember, about 90% of what we do here live for you every day is available in an archived version. So please take advantage of that. Last note, make sure you're following Connie and me on X at Connie Hill CS and at Kevin Horner CS. The best way to meet up with us coaches, aside from the classes that we offer you here on the channel. So let's get to those disclosures, everybody. Please remember that our conversations here are exclusively for your information and your education. We do not make recommendations. We do not make endorsements for a specific approach to trading the market. We do talk technical analysis in this particular class, though, and most of the classes that you see with me. When we do that, we remind you that really what we're covering are concepts and strategies that traders who utilize technical analysis might be employing in their own process. Now, what we want to remind you about there is that, of course, these ideas, these concepts, these are not the end-all, be-all, of course. You should not make decisions exclusively off of technical analysis. And we generally think of technicals and really trading in general as a big puzzle, right? And you take a number of key components to the puzzle, and you utilize those components to make your decisions. Ultimately, we think it can make sense to make decisions based on a multitude of those concepts, ideas, and factors. So if you are new to Trader Talk, what we do is a top-down approach. We start with the major indices, so we will look at the S&P 500, the NASDAQ 100, and the Russell 2000. Today, we're going to also look at the semiconductors, and then we'll work our way through the sectors that are moving around today, maybe even get to some of the commodities on the move. We talked a little bit about that yesterday with my friend Brent Moores. And then, of course, stocks in the news as we round out the session. And like I said, I hope to place a new example trade for the example portfolio here for you all today, which would give us a little bit more to continue to discuss, which is ultimately what we're trying to do here, right? We want to keep chatting about things that traders are incorporating into their day-to-day process, and we want to give you some things to kind of take away. So we'll start with the S&P as we often do. So we don't have a whole lot changing here, do we, everyone? We've got a continuation of the trend off of the bottom here. We are noting that we've managed to maintain that orange 20-day moving average all the way back to when we were below it for a single day back on September 2. So now you've had about a month above the rising 20-day moving average. Really hard to call that anything other than bullish, of course. We know that new highs are not bearish. But that doesn't mean you're all considered comfortable given the way that the market has been grinding itself higher. And I think that's the reminder that I like to bring here. The market tends to do things like this, grind and not give you reasons to be moving out of your positions. But that doesn't mean that all traders are totally comfortable with where we reside, especially if you're in the habit of raising your exit strategies along the way. We've maintained the 20-day moving average this for so long outside of those two instances, but the stories, the narrative, the fear, all of that plays into our emotions as traders. And if you've been able to stem the tide of those emotions and keep those narratives at bay, hopefully you've been managing positions in the S&P 500 by really just sticking with it. Because the bouts below the 20-day have been infrequent at best. Moves below the 50-day have been non-existent since we recaptured it back on May 1. So, we're looking at a good 4 months of holding the 50-day moving average for a lot of traders out there. A trade below, a close below the 50-day moving average would be a very significant development. That would maybe tell us that there's at least a pause in this momentum-based rally off of those tariff tantrum lows. Now, the reason that we want to think about the 50-day moving average is, of course, the percentage that we could see should we make such a move. And I just like to remind you of that approximation of what it would take. So a pullback to the 50-day moving average from where we are today would be about 3.4%. It's not a huge move, as we know. We haven't necessarily had a whole lot of 3 to 5% drawdowns in this rally, but they are common in bull markets. So remind ourselves that when we get these pullbacks, it's not fun. Nobody, especially if we've been grinding and grinding and grinding higher, then you get a 1 to 3 to 5, maybe even 10 sessions up to 2 weeks or longer where things are struggling. It can really start to play on your emotions a little bit, especially if you're in the habit of watching the market dip in the mornings and rally in the afternoon. Dip in the morning, rally in the afternoon. These consistencies give traders a bit of a kind of a misleading viewpoint, right? If you get too much of a grind, well, then suddenly all of your thoughts and emotions are tied to that grind. And when that grind stops and you get some volatility, for example, if we got a 2-day, 3-day pullback, that would be very quick to the 50-day moving average. It would stink. I mean, many traders would probably be stopped out and uncomfortable. And I'm here to remind you that this should be a commonality. What we've seen since May 1 here above the 50-day really is not the commonality. It's a good, strong rally. We don't know how long it can continue, but we have to prepare for the instances where we think it might not. And remember, don't go forward with a feeling of complacency. Complacency is the enemy of the disciplined trader. So try to work your process, know it, stick with it, and have those thoughts so that you know how you want to act should things change for you. So a lot of the same stuff in the SPX as we've seen in the NDX. We'll take a look here. I think the levels are here pretty well set. Now, we do have some bearish divergences, but the reason I have those lines drawn in is to highlight, as Brent and I discussed yesterday, the bearish divergence that we'd had as we'd consolidated in this area. It didn't lead to a breakdown. It just led to the pause. And that might very well be what we could be seeing here right now, everybody. A bearish divergence. Yes, the RSI was into overbought conditions yesterday, albeit lower levels of overbought conditions in the NDX yesterday. And we did close at a new all-time high on the NDX. So a pause may allow that 20-day moving average to continue its upward slope, aggressively upward sloping. And maybe we do go sideways for a few sessions in here. We could even find the 50-day again over the coming weeks, and that wouldn't be terrible. While the S&P 500 hadn't seen the 50-day since we got it back on May 1, the NASDAQ found it right here about 6 weeks ago, I think. Let's see here. Yeah, about 6 weeks ago almost, and bounced wonderfully from there, right? Look at the move we've made. If you bought that low, you've been up about 9% here. So not a terrible move by any stretch for a substantially large position here. So keep this in mind. Again, the continuation of the trend. When we trade trends are more likely to continue than to break. So to carry that bias with you to a certain extent, but as always, make sure we're managing our process along the way. Now, the Russell today is back to doing what the Russell's been doing, holding that 20-day moving average. Notice we're up a little bit today, 0.25%. We have created a series of higher lows along the way. As you can see, we recaptured the 20-day moving average in orange back here on August 12th, so right around the middle of August. That's almost 2 months now, and we are holding the 20-day every step of the way. What are we looking for from a participation standpoint? Opportunities to join the trend, small signals that could tell you that there is a chance that this trend is more likely to continue. Let's just go back in time a little bit. I'm going to pick on a couple of these. So taking a peek at the consolidation we had in here, this candle would not have been exactly inspiring for bullish traders, but it was a hammer at the confluence of the 50 and 200-day moving averages. The 50 in purple, nice and upsloping, the 200-day kind of flat, letting us know that we may be undergoing some consolidation there. But the next day was a real telltale type of candle, a close above the high of the low day being this in the pullback from the peak, right from here, right? So if we view this, and we never know in the moment if this is our low day, but you could see that a trader would perhaps get started on adding or exposing money to a position in the RUT here based on this candle closing not just above the high trade on the low day, but this candle in particular closing at highs this day. And then what did we do? I hope, if you're in the habit of watching this show, would not be a surprise. We break out, you get the new high, the close above the high of the low day, then we need to consolidate. That's not a shock either. Sideways for 5 sessions before another breakout. And now we're talking about continuation from there, right? So we recapture the 20, and then it became resistance. So it was resistance through here for that 2-week window, and then it became support. Right? So here you've got it as support at the 20 right there, support at the 20 right here, and these become your instances where the trader can start to participate or expose funds. So remember, when we talk about exposing money like this, what I'm referencing is not necessarily traders saying, great, we hit the 50-day, time to plow all that money into the position. It's more likely, hey, we got to the 50-day, we have a hammer. Now we have a hold move. Some traders would say that hold, that gives me pause and reason to say, I'm going to try and see if this is the low. If this is the short-term low, then it should hold, and I should be able to commit new money here and see if the trend really is as strong as we think. And if I'm wrong, what would the trader do? The trader would probably look at that low created and say, under this level, I've got to move on, right? So when we say things like low risk areas to join an existing trend, this is what we're talking about. It doesn't mean that there's no risk adding a position here or adding to a position, starting a small position. There's risk, but the risk should be considered limited, because the trader might add money here, but if the trend breaks and trades under the white line I just drew in on a closing basis, many traders would say whatever money they just put in here, they'd move on from. They'd say that was the wrong timing. The trend didn't hold. I'm moving on. I was wrong, right? So we have to have this process as a something to follow, right? We have to give ourselves that playbook so that we can make decisions in the moment kind of quickly. And that's the process that some are considering. So if you joined in and you got, maybe you didn't add on that test here, what would your next test opportunity be? Probably the break through the 20-day right here, or the test and hold of the 20 right here, or maybe it was the big candle day when you determined, oh my goodness, we hit the 20 and now we've made a new short-term high on this huge candle, or maybe it was this one here. The point is simple. These are all opportunity if you think the trend is going to continue, right? Now, eventually, it's not. Eventually, the trend will not hold, but for now, it remains the same. All right, now let's look at the 10-year yield. We talk frequently, for those of you who are maybe new here, about the importance of the 10-year yield relative to that of the Russell, or relative to the movement in the Russell. So a quick look at 10-year yield lets us know that, yeah, we're holding perhaps a short-term low. The technical structure of this is possibly changing, but the long range window tells us that we do have a downtrending move in the 10-year yield. So until we take out that white downtrend line, I think you're apt to see the small caps maintain some of that upward trajectory or bullish bias. However, it's important that we pay attention to the potential to get above it in this zone here. If we were to break that downtrend line, I think you might witness a little bit of maybe some profit taking in small caps, or at least a breather in the small cap move we've seen. Maybe a consolidation period or something along those lines. So it's not a terrible development, but it does bear watching, I would think, right? Because we have, once again, have to have some ideas as to what might shift and make a change to what we've been seeing here. Okay, so not a whole lot to be worried about just yet, but plenty to maybe keep a pin in so that you've got something to be thinking about if and when things might shift. Now let's look at those semis. We missed out on talking about these guys yesterday. They had that consolidation window in the summer, basically mid-June through mid-September. Didn't really go anywhere, and then broke out and have now been trending quite nicely since. Now, of course, my position here, as frequently we do, is working with the 20-day moving average. But I have a feeling that if we looked at the 10-day moving average, we are probably going to find a consistency since the breakout here as well. So I'm going to quickly click my 10-day, and sure enough, since the breakout, we've held the 10-day for the entirety of that move. Breakout occurred with this gap on September 10. And if you're simply trading the trend, a way that a lot of traders are going to look for this is when we get a close under the 10-day is when they start to pull back on their trade. Right now, you don't have it. Okay, what are we doing? We're holding up. We've continually seen a multitude of gaps, and a lot of traders maybe look at this zone here, or even set a low at the low of the gap since. So something along that might be an area for managing risk in the semiconductor index itself. But again, strong moves. Let's not get too far beyond the basics, right? Uptrend, lower left to upper right. Additionally, having broken that consolidation period, it is not just not uncommon, it is consistent, where what we'll see is a consolidation breakout lead to a trend thereafter. The question becomes, which way is the breakout? And so if you were, as a trader, just watching this consolidation and saying, well, nothing's happening, I'm going to wait for it to break the consolidation and then I'll know. Well, then the trader waited, got in on a gap, and held the 20 or the 10-day moving average every bit. Since then, they've got a way to manage their risk along the way. Obviously, if this broke down, the thought process would be the same, right? Start breaking to the downside, and now we can have the potential for a new bearish trend thereafter. In this case, it went to the upside, and the key about this breakout, by the way, is the level, the 5830 level, the green line. If I kick this back to the weekly chart, you'll see why. I mean, this looks, what are you going to say? A long range pattern here where we tried a complete and total breakdown and then got into resistance and went sideways for 2 months. This has the look of a bit of a wide, like a really large coffee mug cup and handle, right? Because you could say, oh, you kind of got it like so, like so, like so, and then here is your handle. That's what all of this stuff is right here. The 2-month handle, hanging on to that. And then when you got above the green line, now we take off. And so that technicians would say that there's more upside from this. The only real question becomes, is it more immediate upside? Does it require a test of support? That all remains to be seen. We really just don't know. That's where it becomes incumbent on us to manage our own risk relative to what we're seeing on these trades. But you can have, these concepts, kind of held in your mind as to what you might expect to see or justification for why we're seeing what we're seeing. But the ultimate, the most important aspect, regardless of your technical read, is to make sure that we as traders are still comfortable with what we're doing. Don't put yourself into an uncomfortable exposure to the market. Don't overinvest. Try and keep yourself grounded to a certain extent. I know that's difficult for many of us, myself included. It's one of the main reasons that a lot of traders will do things like piecing into these trades, as you know, right? Starting small, starting with a 25% position size or something along those lines, maybe even 10. Ultimately, my encouragement for all of you, as many have heard me say, is to define some of these concepts for yourself. It's important to recognize that we have these concepts, and that as traders, the key is that we're all so different that what works for you is not going to work for another trader, right? So the job is to define things like full position. What is a full position for you? For some traders, it's $10,000. For some traders, it's $1,000. Some traders, it's a heck of a lot more. My point is pretty simple. If you're going to try and put yourself into comfortable trades as much as possible, well, defining your full position and then further stating, well, if things are if I'm less confident about a move and but I still want to participate, well, then I'm going to start with a proper percentage of my full position size. So some traders, if they are not confident but they feel compelled to take a shot, well, then they start with 10% or they start with 20% instead of the full. And then when things are proven to be working, then they add to that trade. That's one of the hardest things to do, I've noted, though. Many of you, you can let me know. In fact, I'd love to hear from you. How many of you are not comfortable adding to trades that are working in your favor? Are you bogged down by the idea that the thought that you're paying more on a per share basis to add to the trade? And that's not uncommon. That's very common, especially for traders who are still working through their own process and figuring things out. But, if you are not comfortable buying at higher prices, assuming you're buying at areas where the trend is supported, well, then I think you've got to work through that. I know that not everybody's going to, and that's fine. If you want to find yourself a buying low investor and working your way to always be buying at support rather than buying on breakouts or adding along the way at higher prices, I just want to remind you, the thought is pretty simple. If we buy into the beginning of a new trend and the trend continues and you look for instances to add new funds along the way, at the trend line, at support, etc. Those are the things that are evidence that the trade you stepped into is already working in your favor. So you might start on that original breakout and say, boy, if I could just get an entrance at the 20-day, I'd be happy to add to it. You know what? That's okay. There's nothing wrong with paying higher prices if the expectation is still higher prices thereafter. Okay, I know that's a challenge. That's one of the reasons watching every day, trading it, exposing and working this process out can be so helpful to your really adding a history to your Rolodex of market monitoring, right? And that's why a lot of you work the paper money platform. You use the paper money version to get comfortable utilizing these concepts, starting the process of being a disciplined trader without real money on the table could make that process a little easier for you. So I'm seeing a lot of great answers here. Guilty is charged, Quinn. Okay. I like adding to what is working. Good there. I do, but I do keep an eye to get into buying on dips. Nothing wrong with that, Vic. Add all the time with the slices. I like the idea of that. That's an interesting concept as well. You can, of course, find out more about the stock slices opportunity there via schwab.com. I'd certainly not want to discourage you from that, so that's okay. Let's see. Yeah, learning to do trades that are working in my favor, but it's the opposite of what I used to do. Okay, so Silas is saying, hey, we've maybe started a process of growing as a trader. That's an excellent thing. Again, I'm not here to tell you that there's one way to trade. There's not. Obviously, there are hundreds or thousands of ways to go about trading the market. I think the most important thing, though, is having a process that's comfortable for you. That's something that makes it easier on you. The market's difficult enough. Don't make it harder, right? Try and be as simple as we can so that we can be good traders and disciplined traders. Those are the things that come out favorably over the long haul, most common. Okay, so we've got a little bit of red here this morning. One of the things that might be playing into some of this early morning negativity, I'll mention we are going to be hearing from some Fed speakers today. So Mr. Chairman Powell is speaking this morning as early as 8:30 Eastern. So there's probably some headlines that I've just not had a chance to get to here. Maybe keeping things a little under wraps. We also saw a little bit of broad market weakness earlier in this week and kind of tied to Fed speak as well, but never a problem to just kind of keep an eye on some of that volatility, especially in the midst of potential headline risk. So we've got Powell speaking this morning. You've got Bowman speaking this morning. We're going to hear from Barr this afternoon, and then Bowman later this afternoon again. So, headline risk could be part of the process here today. Let's take a look at some of those other important aspects before what we'll also hit up some of the sectors here. But I know many of you are wondering about those commodities. So let's quickly hit up just a look at the futures. And I'll remind you that we're just looking here for an understanding of movement, not looking at this from an analysis, other than to say, boy, we took off that lid on the price of the gold here around 3,500. And once more, that concept holds, doesn't it? Breakout trend, right? We've been holding the 20-day since, probably holding the 10-day since as well. Sure enough. So pick your moving average here. Know how you want to manage, as is often the case. Silver making similar moves. Look at that one against the 10-day, everybody. Here you were in consolidation for about a month, right? July 9 until, longer than that. 6 weeks. July 9 to August 28, and then we broke out and held the 10-day ever since. So more of the same for both gold and for silver. Let's see here. What about oil? Quick peek here on oil. Let's put those major moving averages back up. How about the 200? Okay, so we remain below the 200, as you can see. The 200 now coincident with the former resistance here at around 66.5. And I think it's also notable that we stayed in this consolidation. We fell out of it, but now we're kind of trying to get back in here. This has just not been fantastic. If you're trying to be a bull for oil, you don't have a whole lot of trend reasoning here just yet. So nothing wrong with that for the time being. I'll remind you, lower oil is disinflationary. So not a negative for the broad market if oil were to continue lower, especially after having broken this trend and now kind of gotten back into the trend. If I was going to just evaluate this move from the peak here, it's kind of looking like a bit of a short-term bear flag, right? You could draw it right like so from this peak to here. You've got a little bit of an uplift. So it's kind of looking bear flaggish. If this were a bear flag, you'd have to take out the uptrend line, and most traders would tell you got to trade to the new low. So basically under 60 a barrel would be a key. And then if that were the case, it does give you a chance to look at these prior lows that we hit in the spring last year with about 55, at around 55 a barrel. My goodness, that would be another view that would speak to the disinflationary overall opportunity here in the market. So kind of notable there as well. Now, let's look at one more. How about Bitcoin real quickly, see what we have in the way here. Even if you thought that we were getting a breakdown, boy, it did not materialize, did it, everybody? We moved out of that. We made new highs this week. Monday, it looks like new highs in Bitcoin there. A little bit of a something some traders would reference as a bull flag now, right? Because you're seeing here, you got a quick, speedy move, and now you've got this little pennant happening here. And so a break to the upside could be a nice explosive move. Looks like the upside move here was about oh my goodness, almost 18,000 points from this support test. I'll draw that in as well, something like that, right? Yeah, so from not too shabby here, pretty good move, 10% or so, or 17%. Goodness. So, all right, little bit of a validation, if you will, with the risk on concept. We don't know if that's going to continue, of course, but that's what's happening right there. And then the last one we'll hit there is Ethereum. And that's more of a consolidation at this point. Let's just activate this line and let me reset everything here. So this looks more like a recent test. And then today it's kind of in a bit of a pullback, pulling back from a lower high. So we might be kind of range bound. Can't say I'm surprised when I look at what the RSI is telling me here. The fact that we got into that resistance band up above and didn't break out, for a lot of traders, they say, yeah, I'm not shocked because we've got this bearish divergence working here from the last time we peaked, when we made the initial peak. This, again, not a reversal signal necessarily, but rather consolidation signal, perhaps. So we'll kind of keep an eye on that. All right. So with that in mind, let's look at some of those sectors before we get to some stocks in the news. So our weakest sector here this morning is discretionary, but not terribly weak. Let's get all our moving averages back in there. We're pulling back to the 50-day. This should not be, at least as of yet, major concern for investors in this sector because, as you can see, above the 50-day, coincident with the May 1 move that the broad market made, we're looking at potential test of the 50-day once more here. Bit of horizontal support, perhaps as well, right in this zone. You know, these prior lows in this area. So that provides a little confluence for the discretionary space. Secondarily weakest is industrials this morning. Industrials have been strong, though, had been at a new high. In fact, made a new intraday high today, albeit on a lower high in the RSI. So we might be under a little bit of consolidation here when you look at what's happening with industrials. Now, what about those staples? So today, since some of this weakness is showing its face in the form of a little bit of a risk-off maneuver, and I say risk-off, it's not huge by any means, but staples are up a little bit after having broken down. So when we talk about a little bit of shorter-term rotational action, not a terribly shocking maneuver to see some of the risk-on groups breathing or pulling back, and therefore some of the risk-off groups may be benefiting from it. But I think the broader reminder here is there are some developing bearish trends in staples here. Most notably, we broke the 20-day back here in late August. We've been below it since. So now you're looking there at about 6 weeks, about 6 weeks below the 20-day moving average, a new downtrend that is pretty clearly in place. So we have to be aware of that. But again, that's not a negative for those of you wanting the broad market to continue doing what it's been doing. We're not likely to see staples get itself in gear and start being a leading space unless and until the general market participants are uncomfortable with risk. We've not seen nearly the movement into these cyclicals and defensives as much as you might expect. Now, from a positive standpoint today, we've got healthcare continuing its move higher. I hope some of you have been who've been watching this show have maybe been making note of this, because we've been talking about the recent change. In fact, I started to get a little bit kind of interested in healthcare with this candle at an area of support. Said, all right, I'm going to make note of that, and I make sure I talk about that with all of you. But then when we made this gap maneuver here in mid-August, and most importantly, held it, that's when things started to look a little different, because that movement allowed that 50-day moving average to finally give us that swing, right? And now you'll see, what do we have is a bunch of confluence here. We've got that 20-day rising moving average through the 200. That's a positive. We've got the 50-day a bit slower than the 20, but working its way up towards the 200. And of course, what we've seen has been a pretty explosive move out of healthcare of late. But I'll remind you that is not exclusive to the sector, or what I mean to say is that's not solely the entirety of the sector. There's been some leadership with biotech, and so I'll just put a reminder of how biotech has been acting. Pretty nice development here where the sector of healthcare resides below the 200-day moving average. The biotech industry is doing better, right? We're above the 200, we're above the 50, we're above the 20, and we've taken out what was a major resistance area. So I'm going to color that one now green. And notice now, what are we doing? A lot of traders would tell you we're developing a bull flag or maybe a bull flat, depending on how you choose to term it. But ultimately, that is not a negative at this point. Now, could it break down and mean we have to come back and retest? Yeah, absolutely. We don't know. But it could keep going from here as well. Overbought conditions tell us that that's validating the strength of the trend. And then, of course, we need to make sure we peek out at a longer term window. Let's just back this off and see. I think I've got a weekly. Oh, I guess not. We're going to add a few years to this. All right. So can we learn anything else? Well, the one thing that stands out, if we don't look historically at when we get big moves, well, we might be missing the forest for the trees, right? Because look at what we had here when we got really, really weak in March, early April. We clearly reached support. The question was whether anyone had the guts or the chutzpah or the dollars to devote even. What an excellent entrance opportunity that could have been for this space. But I bring it up because I got to remind us, we have to look at varied time frames. It absolutely assists us to shift your trade time frame and look in a longer window and see if some of what's going on today coincides with stuff from the past. We can also learn something quite a bit. All right, so there's your kind of your sector review essentially. Otherwise, I think we're just taking a little bit of a breather here. We'll see to what extent that continues for us. Now, let's go ahead and talk about some stocks in the news. We had some upgrades today, so I want to share those with you. And then we'll look at our example portfolio and the example trade. So the first thing we're going to look at is DraftKings. So DraftKings was upgraded. Oh, I've got some lines in here. Okay, DraftKings was upgraded by Berenberg to buy from hold. New target here is at $43. That's actually down from the original target at $45. Volatility of prediction markets and the price of the shares dropping here have kind of created some opportunities, according to Berenberg. And so, by the way, those prediction markets, ultimately there was some story recently about these prediction market companies having opportunities to give another way for traders and interested parties to maybe speculate on certain circumstances, whether that be sporting events or elections or what have you. And I think that's led to some of this short-term short-term weakness associated with something like a DraftKings. We should look at the long-term chart here to see where these lines are coming into play. Okay, and that helps you out a little bit. We're sitting on the bottom of a intermediate term uptrend, so to speak. Looks like a bit of a triangle in there developing. But if nothing else, traders might look at it and say, well, under the white line, the probability for more weakness might kick me out of the trade. Something some traders might suggest. So they might move on trades or closes below the uptrending white line there. That's one way to look at it. But in the short run, a trader could say, hey, I'm going to make a purchase based on oversold conditions, based on an analyst upgrade, and it would possibly be counter trend, but that doesn't mean it can't work. Not everybody's comfortable, though, buying stock under a 200-day moving average. And really, when you look at this is just not a whole lot of trend, is there, right here? It's kind of difficult to suggest. There was an uptrend that was working great for a while above the 50-day here, right? From about, say, June 9 until it wasn't here on September 12. So you had about a 3-month rally, and then that rally was over, and then it gave it all back. Wonderful representation of why traders who trade in the short run Oh, we caught the 50-day, time to go long. Great. Now we broke the 50-day, time to cover our trades, right? That's one of the reminders that traders who are trend traders have to kind of adhere to, okay? So bear that in mind. Now, so there's an update on DraftKings. Another one that's been kind of moving, this one might be interesting, is Roblox. Now, Roblox got an update. MoffettNathanson analysts upgrading Roblox to neutral. Previously, Roblox had been a sell. The firm still struggles to, quote, make sense of the valuation, end quote. They note that the user metrics have exploded higher and that the inflection has been driven by new viral experiences. So Roblox is playing a different game, according to the analysts at MoffettNathanson. Competition is few and far between for experiences that lean into quick and socially driven viral interactive experiences. So they're liking it from that standpoint. I don't have a price target for MoffettNathanson on Roblox, but what's intriguing to me as the trend trader is the break of the uptrend. If you were working with the 50-day moving average, that's cool. You're below it now for 5 days, right? Some of you would say, Kev, that fits into your Horner rule conversation, doesn't it? And I would say, yeah, it does. If you are below what you deem to be support for a period of time longer than you're comfortable, some traders would say that this action, violation of the moving average and the trend line, tells some traders, okay, that's weakness that I need to adhere to. That tells me I should be covering positions. That's how some traders would look at that. 3 days, 4 days, 5 days below the major moving average might be a reason for some to move on. Now, if a trader wants to buy in believing in an upgrade from MoffettNathanson, they might say, well, you know what? I'm not ecstatic about it being below the 50-day, but I don't mind the idea of maybe putting on a portion of a partial trade here. Maybe it's that 10% or 20% of your position size so that you could get started and then see what happens. Moving on if it made a new low under 119, for example. Okay, that's a wonderful thought. And I say wonderful thought in the sense that it's defined the process. The trader says, okay, I'll start small. If I'm wrong, I'll know it under the 119 level and I'll move on. If I'm right and it recaptures the 50-day, maybe then I add back. That's just a concept, not a recommendation. I hope to remind you all. Now, let's look at our RTX position. Our example trade in this class is RTX. We've got a 17.5% position here. A profitable position. We bought back here on a test of the 20-day and have managed to stick with it the entirety of the time. Now we've managed to move to new highs. We've got a stop that resides appropriately below the 50-day. I say appropriate by the amount of the average true range, $2.50, $2.60 beneath the 50-day moving average. So that would be about, as long as we're above or at around 156, we're good. So we can raise our stop to around 156 or so, which would incorporate the ATR and the 50-day moving average. And this is going to work to aid in trying to maintain as much of the profit as we can. I'll remind you all that when we work with a stop order like this, it's not a guarantee of price. What we're doing is triggering at our new stop price of 156.27. And once triggered, it becomes a market order. So we can't guarantee any price in any way. But it's important that we still work to elevate our stop orders like this, because that's how we go about mitigating our risk. It doesn't mean we eliminate risk, but we reduce our risk. I think that's the key reminder here. So yeah, RTX getting a little bit of a pullback today. We're off the high from yesterday, but by no means a bearish look at how this one's moving. Still continues to be a bullish pattern, a bullish chart, and we'll continue to manage and monitor our RTX example trade for you here in this class. So looks like we are at time, everyone. A little bit of a quiet morning, a little bit of a red morning, depending on where your money is invested, perhaps. But nonetheless, another day on the table, and we are going to be hearing from a number of key Fed cohorts today, so make sure you keep your ear to the rail. More to come from us here on the channel, as always. Big thanks to Connie in the chat today. Follow us there on X, Kevin Horner. CS, Connie Hill, CS, and make sure you're subscribed to the channel. And because this one is going to be in the archive, everybody, a thumbs up down below if you liked the conversation. That would help us out a bunch as we get this out on a replay basis, sharing it with all the viewers who are unable to make it at open today. So hope you all have a fantastic Thursday. I look forward to catching up with you all again real soon.